In the past couple lessons, you learned how to calculate how much money you owe from income taxes each year. Don't tell your friends you know how to do this, or else they will want you to do their taxes too. But when you actually do these calculations, you might be a little caught off guard as to how high the amounts seem to be. Well, one thing that a lot of people forget about tax brackets is that they only show you how much total tax liability you have. But the actual amount that you're on the hook for is usually a lot lower. In fact, it's pretty common to not owe anything for your taxes. Or, better yet, actually get money back from them instead of having to pay. In this lesson, we're going to learn about two types of payroll deductions: pre-tax deductions and payroll taxes. And we'll take a look at how they work and how they can affect your tax bill at the end of the year. Let's get into it. We are so close to being done with learning how to file your own taxes. But first, we should rewind. We need to go back in time. Oh, no, too far. Go back. We have to go back to when you first started earning the income that will eventually be taxed. Your first paycheck of the year. You earned your paycheck through hours and hours of sweating down in the coal mines or whatever your job is. But when you get your paycheck, you won't have all the money that you earned. Some of that money was taken out of your paycheck, but for a very good reason. Several good reasons, actually. A payroll deduction is when money gets taken out of your pay before you receive your paycheck. There are multiple different types of payroll deductions. Pre-tax deductions are the first things that get taken out of your paycheck. These are to pay for certain employee benefits, like healthcare or retirement plan contributions. They're called pre-tax because they come out of your paycheck so quickly that your poor W-2 tax form doesn't even know the money existed in the first place, which means that your taxable income will be lower when you go to file your taxes. Let's say you've got a really good job where you earn $10,000 every month. If your health insurance costs $127 a month and you contribute $800 a month to your retirement plan, how much of this month's pay will be reflected on your W-2? Pause and take a moment to answer. After these pre-tax deductions, your paycheck for the month will drop to $9,073. Alongside your pre-tax deductions, you'll also be paying payroll taxes. Payroll taxes are taxes that you pay through your company's payroll system before they send you your paycheck. You might notice a tax on your pay stub called FICA. This stands for Federal Insurance Contributions Act, the law that mandated Social Security and Medicare tax contributions from nearly all working Americans. These taxes take 6.2% and 1.45% of your income, respectively. Payroll taxes also include income tax withholding, which is extremely important. Income tax withholding is money your employer removes from your paycheck before paying you and sends it directly to the government in your name to help pay your income taxes. When you first get hired, your employer will have you fill out a W-4 form, also known as an employee's withholding certificate. This gives your employer enough information to estimate what you'll owe in income taxes at the end of the year, so they'll have an idea of how much to withhold from each paycheck. The problem is, this is only an estimate. Your employer has no way of knowing what adjustments you'll claim or whether you're going to take the standard or itemized deduction, so they may withhold too much or too little. Back to that paycheck from before. In addition to pre-tax deductions, we also have to account for payroll taxes. FICA taxes will take a combined total of 7.65% of your gross income, or $765, and from the information on your W-4, your employer has concluded that $1,040 should be withheld for income taxes each month. How much pay will you actually be taking home from this paycheck? If we subtract pre-tax deductions, FICA taxes, and tax withholding from your gross pay, you will still be taking home a total of $7,268. Not bad. Now let's fast forward to the end of the year where it's tax filing time and find out how much you owe. You do all the math and you find that your tax liability is $9,760. That sounds like a massive amount, and you might stress out because you don't have that much saved up. But remember, you've withheld $1,040 each month for a total of $12,480 over the whole year. You've already paid more than you owe. So you don't owe any more money. This is the part where most taxpayers start to jump for joy because they've just earned themselves a tax refund. That means that you overpaid your tax withholding. So when it comes time to file your taxes at the end of the year, you will actually be getting that excess money back from the government instead of having to pay more. Don't get too comfortable though. While tax refunds are pretty common, they don't always happen. In fact, the opposite can happen too, where your tax withholding was too low and you'll end up having to pay more to make up the difference. Even then, your tax withholding is still a huge help. Going back to those previous examples, let's say that your tax liability was actually $13,000. With $12,480 in tax withholding, that will bring your tax bill down to a much more manageable $520. To summarize, having an employer take money out of your hard-earned paycheck might seem a little sketchy at first, but it's actually for a very good reason. Pre-tax deductions pay for things that you were going to pay for already, but it makes that money non-taxable. And payroll taxes include things like the 7.65% FICA tax, as well as income tax withholding, which can dramatically lower your tax bill. Before we go, I want to give you one word of caution. If you're self-employed, there is no such thing as a payroll deduction because you're not on a company's payroll. Instead, you are going to have to intentionally set money aside to pay for things like health insurance, a retirement plan, and FICA taxes. In addition, you are going to have to send in income tax withholdings every 3 months. As I've said before, it takes a lot of financial discipline to be self-employed. Now, after your wrap-up and assessment, we are going to be taking a step back from the math side of things for a bit, and instead taking a look at the language side of it. Have you ever read a tax form? There's a lot of complicated words and confusing phrases and things in there. So I'm going to give you a big vocabulary lesson. That way you will be able to understand what's going on when you do your tax forms at the end of the year. See you then.